Good evening and welcome to tonight's presentation. This is an exclusive for chat room members. Hopefully we'll have a lot more of these in the future. We've got a very special guest that's going to be leading us tonight, and that's Dave Wyse. All of you know him from the chat room. Dave is one of the primary traders. You can tell by the quality of the posts that he makes that Dave is very successful. It doesn't come by accident. He and I often talk this time of night. We're both doing our research, probably put in a lot of 12-hour days. We're constantly working and looking for new trade ideas. That's what it takes. So when Dave turns on his computer the next morning, he's already got a list of 5, 10, 15 stocks that he's looking at, and then he's also finding new prospects in the morning. So he's going to be going through some of his processes that he uses to identify these stocks after hours and some of the different methods that he uses during trading hours. So I'm going to pass everything over to Dave. Dave, if I could have you unmute your microphone, I'm going to pass the controls over to you.
Okay, I think it's on.
All right, excellent. I'm going to change over to you right now. And then we should be seeing Dave's screen here very shortly. And thank you again, Dave. Really, really appreciate all that you do in the chat room. And I'm excited. I know I'm going to learn some things tonight. So why don't you show us what you've got?
Okay, I appreciate it. You can see my screen okay?
Yes.
Okay, cool. Very good. Well, thanks all for coming and listening to me. You know, Pete's asked me a while back to if I could go over some of the strategies and methods that I use in conjunction with his platform and his scanner, and I said, sure, I'd love to. I mean, it's something I've been working with Pete for quite a long time. So what I really want to do is I'm just going to kind of run through a couple of quick slides I've got here. This just to kind of give you a little background on how I got to where I am as far as trading is concerned. It's a fairly long process, but and you can read these things. But I started investing about 10 years ago, and I was just investing in stocks. I wasn't doing any options or anything like that. I was just basically investing in dividend stocks. And I started to do a lot of research online as far as trading was concerned for options and day trades and intraday trades and swings and those kind of things. And I spent, as Pete said, probably 12 hours a day learning these things deep into the night. And I was fortunate enough to come across Pete about 6 years ago. And I was pretty impressed with his methodologies and the education that he had. And that's where I learned a lot of the techniques that I use and learning to trade options, things like that. So I've been trading with Pete for about 6 years. I traded part-time for about 2 years, and then about 4 years ago I retired from my IT career and began to trade full-time. And it's I think, as Pete's probably told you before, it's quite a dramatic change when you go from doing it part-time when you've got a job to doing it full-time and depending on it for income. It changes everything. It's kind of like going from a paper account to a real account. So from there, I started to learn to write covered calls and cash secured puts on my dividend stocks, and that gave me a little bit of background on learning to trade options. And then I went to doing spreads on options. So that it was kind of a gradual, step-by-step method through the whole investing and trading. I didn't just jump right in and start doing everything. I tried to learn each one of the particular methods, and when I started to trade options, I traded one contract at a time. And remember the first time that I did a put credit spread, it was the first time I'd ever put one on, and I was sweating bullets when I put the thing on. I wasn't, you're nervous about when you try to do new things like that. So I've been doing this for a good long time. This is the methods that I use. I'm what's called a directional trader, the same as Pete, and which means I typically don't do things like you might have heard about, like iron condors and strangles and straddles. I'm basically depending on the market, getting the market direction correct. and I use both stocks and options to do that. I trade intraday, of course, swing, and I do credit spreads and or a combination of those depending on market conditions. And I trade almost entirely based on technical analysis. I don't really do too much as far as the swing trading and day trading as far as fundamentals are concerned. A lot of times when I trade, I honestly don't even know what a company does. I mean, I know a symbol. I have no idea what the company does. I just know technically it sets up really, really nice. And the trading plan that I go through, and I'll get into a little bit more detail of this, but basically I have to identify high probability prospects. Any trader, every trader, in order to be successful, the key thing that you need is you need good prospects. You've got to have good stocks. You can't be searching through 8,000 stocks every day to try to find prospects. And that, of course, that's where Pete's scanner is so useful, because that gives us some real high probability prospects. Now, beyond that, when I take a look at the prospects, I have to make a determination of which one of these prospects have the highest profit potential, or which ones of them have the highest profit potential. And I'll go into what particular method I use to do that. Then I have to look at the trade, and I have to make an initial determination whether I'm going to trade this stock for an intraday trade or a swing trade. And there's a big difference there, because the levels you're going to use for taking profits and the levels you're going to use for exiting based on resistances, breaking through and things like that, breaking down through a support level, is going to make a determination of whether it's an intraday or a swing trade, and those levels are going to change. Then I have to decide whether I'm going to use stocks for this trade or options for this trade. And Pete's talked a lot about the option IVs and at what point in time you can buy puts and calls, and at what point in time you need to use stock. So there's, it's obviously what the implied volatility of the options are, and also how liquid are they. I mean, am I going to get a 30-cent spread on the options and get stuck in the trade and spend the rest of the afternoon trying to get out at break even? And then I have to determine the support level for an exit, which would be also a take profit level, and an exit if it breaks down. One of the things that I use is their convergence. And I'll get into a little bit what convergence is, but basically it's a combination of multiple things for a particular stock that are working in your favor. When you look at the ones that Pete's put up there, the ones that are the high prospects, there's 4 elements that are there. You've got a stock that's got a buy signal. You've got a stock that's got some recent volume. You've got a stock that's done compression, basically went sideways for a while, and then you got to stop breaking out through a level. That's 4 elements. Then there's other elements I use, which would be if perhaps the stock is bouncing off one of the moving averages, a 50-day moving average or a 200-day moving average. What's the candlestick pattern look like? Is it a hammer bar on the candlestick that's giving me confidence that this is a good entry point? So the more of those things that you can put together, which you call convergence, the more of those you have, the more likelihood there is of that stock performing the way you expect it to. And this isn't really part of the trade planning, but is the trade performing as expected? And what I mean is when you enter a position, you have an anticipation of what you think that stock's going to do and how soon you think it's going to do it. And if a stock's not trading as expected, then at some point in time, usually pretty quickly, you've got to say, okay, I was wrong on this trade. I'm not going to just hope that it's going to turn around. This is not doing what I expect it to do. I'll just exit here and look for something else. And that's really important to make sure that you put your ego aside and not try to prove that you're going to be right on every single trade. That's a big no-no. We only need to be right 50% of the time if we're making 3 times the money that we're losing every time we do a trade. So that's those are the kind of the elements that I use. Now, when I bring the charts up, there's some indicators that I use on the charts, and I think you guys have probably heard me in the chat room talking about these things. But the key indicators that I use are obviously a buy signal. I try never to trade against a stock that's on. I don't go long a stock that's got a sell signal, and I don't go short a stock that's got a buy signal. I found that the algorithms that Pete uses to develop these signals are pretty accurate, and I'm generally not going to try to second guess those things. Obviously, I'm looking for a horizontal break of some resistance line if I'm looking for a long, and I'm looking for a horizontal break of the support line if I'm looking for shorts. Then I have, and I have up on the platform right here, I have 4 moving averages. I have the 50-day simple moving average. I have the 100-day simple moving average, and I have the 200-day simple moving average. Those are the 3. That's 100 is black. The thick red line up here is the 200, and the 50's down here. Now the little purple line you see running through the chart right here is the 8 exponential moving average. And that's one that I use for day trades and swing trades, especially for swing trades. And it's been my experience that if a stock on the daily chart is able to stay above that 8 exponential moving average on a long, then it's reasonable to stay in that position. If it breaks down below that 8 exponential moving average and closes below it on a particular day, then I tend to assume that that's probably a good time to take profits and get out, or take my losses and get out, because it's not holding up. And it's an arbitrary line. You can use a 6, you can use an 8, you can use a 9, but I found for this it's a good guide for me to use, trying to make a determination of whether to stay in a trade or not get into a trade. I do draw some trend lines on the charts. You'll see when I put up some of these charts that I actually draw trend lines, which I connect candlestick bottoms and tops together to do that. And the last thing that I use, and Pete's expressed this a lot, is relative strength. And I basically just compare the SPY to the particular underlying stock that I'm considering getting into, and I'd much prefer to trade stocks that have relative strength to the upside, if I'm going long, and relative strength or relative weakness to the downside if I'm going short. You're going to find that if you use those particular criteria, when you get into a trade, you obviously want the market going with you. But if the market turns against you, you're going to find the stocks that have relative strength. They're not going to fall as fast as the market does generally, obviously, because they have relative strength. So you may lose some money on the trade, but you're much more likely to be able to exit that trade at a much smaller loss, or even maybe a small profit, than you would be on a market reversal otherwise. So those are basically the indicators that I use, and I'll go over some of these things, how I use them in my particular methodology. A couple things that I kind of wanted to cover. You always need to know, when you get into a trade, you need to know why you're getting into the trade. You have to have a reason for it. I post trades out there in the room. Everybody posts trades out there in the room. But no matter who posts a trade in the room, whether it's Pete, me, or somebody else, I always look at the technicals to make a determination if that particular trade is one that I want to take. Because ultimately, you're the one that's going to make the decision as to whether you're going to get into that, and you're ultimately going to be the person that's going to win or make or lose money on that particular trade. So you have to take responsibility for it. So it's very important that you have conviction on the trade that you're getting into. So you need to know why you're getting into it. It's obviously if it's breaking through the pattern, it's got good volume. I'm getting into it here, and I know why I'm getting into it. Now you also need to know, when you get into a trade, you have to have a pretty good idea of where you're going to exit that trade, both to the losing side and to the winning side. So you should have some targets set. They don't have to be, I don't set stops until I get close to getting out of a trade, but you need to have an idea of how far up you think the stock could go for if you're long, where do you think it's going to go to, and where should I get out, and if it breaks down, where is my support level on this stock, and when will I exit that stock? And when you do that, you just have to do it. A lot of times people tend to stay in trades longer than they should because they think it's going to turn around, and they don't want to take a loss. But you just got to take a loss. It's part of trading. You're going to lose many times. Just take it and move on and forget about it. The only thing I would say is, when you do have a trade that doesn't work out the way you want, it's important to analyze it later, like at the end of the day after you're done trading. Analyze that trade and make a determination of whether the trade was a faulty trade, a trade you shouldn't have got into, or maybe you get into it at a bad spot, or if it was a good trade that just didn't work out. And there's plenty of those, plenty of trades that if I saw the trade 100 times, I'd get into it 100 times, and maybe it failed. That's part of trading. And one of the important things, and I think I've stressed this in the chat room a few times, it's to trade your technicals and not your P&L. And what I mean when I say that is, a lot of people, when they're trading, they're looking at how much money they're up or down in a particular trade or for the day. And it's really important not to really take that into consideration when you're trying to make a determination whether to stay in the trade or get out of the trade. When you get into a trade, you're getting into a trade based on your technical analysis. Why did I get into this? It's breaking out through a resistance level. Okay, so you're into the trade based on that resistance level. Where am I going to get out? Well, you have your idea of where you're going to get in and where you're going to get out. Now, if you're watching your P&L, and let's say you get into a trade and it goes against you, just as a random number, $300, and you're down $300 on a trade, and it hasn't gone down and broken through your support level. You still should be in the trade, but you're looking at your P&L and you're nervous. Now all of a sudden the stock, which you liked when you get into, all of a sudden it shoots up now, and a few minutes later you're up $150 on the stock, for example. Now you get a green P&L. Now it sets back and goes down to like $75 up instead of $150 up. And I'm just pulling these as figures. But if you're watching your P&L, what happens is you were nervous and worried about losing money, and now it went green and you started to lose some of those profits. You'll get out of the trade at that point because you want to protect your profits. So you're actually getting out of the trade based on what your P&L is telling you, not what your technicals are telling you. If you were trading your technicals on a trade like that, when the stock came back up and started performing the way you expected it to in the first place, you may actually should be considering doubling up on the stock, adding to the position, as opposed to exiting the position. And this is really important because what happens is you've picked a beautiful stock, a beautiful trade to get into. You've gone into it based on your technical analysis, but you gave up on the stock when you had a small profit, and maybe the stock runs another $2 or $3. So you haven't maximized one of the good trades that would have worked for you because you were watching your P&L. I hope that makes sense. It's basically what you're trying to do is eliminate the emotional part of the trading. And if you can put your P&L aside for a minute, that it helps a lot. If you can just basically look at the P&Ls and say, okay, I'm going to get out at this point because technically I should get out at this point, not because I'm losing or making money. I hope that makes sense.
Dave, do you have an example of one? I know you and I have stuck with a couple of overnights where, we've let the position move against us, and it's like, well, longer term, it still makes sense.
Let me think. There was one. What was one we had?
Well, I had PCTC or PC.
Yeah.
That was one that I stuck in, and it moved against me, but I thought.
Let's see. Okay, that comes up. Yeah, if you look, for example, I'm trying to find where we get into that thing, but
I think it was about 4 days ago. It was compressing. We got the buy arrow after the earnings.
Right here. It was right, and I think it's right here on this green arrow right here. Can you see that? You can see where my pointer is?
Yes. Yep. Exactly.
Okay. So that right there, and you see that was a good trade. I mean, if you look across here, maybe just do a line. You see where we get into that trade. You see the big red arrow to the left and this arrow here, and then this big green bar here. Those are upside potentials on that particular stock when you went to the trade. Now you notice that it went against you, and it went against you that day because it was way up here and it pulled back again. But you notice that it hasn't broken down, and you had 2 more days of basically just kind of going sideways. So at that point, you may have considered getting out of the trade. But look what it did 3 days ago, 2 days ago, and today. And you notice that you want to notice on this particular candle right here, you notice where that went to. It basically went right to the top of this red candle right here, and that should have been one of your, when you get into the trade, that should have been one of your profit targets if you were swinging that particular trade. And that's kind of what I'm talking about, is getting shaken out of a trade, even though technically that trade was a solid technical trade. But if you had exited down here, or even on the day that you get in, look what you'd be giving up. And that's the important thing, is to try to maximize your profits and minimize your losses. Everybody tells you that. Let your profits run and cut your losses short. It's not so easy to do. But in cases like this, if you're just following your technical analysis, it's going to make it a lot easier for you, because basically you won't get shaken out of trades as quickly as somebody else, perhaps. I hope that makes sense. All right, I wanted to run a little bit through what the procedure is I do each night and each morning to get ready to trade. As we said before, it's really important to have prospects. And I'm going to bring a chart up here. I mean, one of my platforms. This is a trading platform that I use. It's called TC2000. But what I do at night is I set up, and I do it in Pete's platform, and I do it in TC2000. I go through the Pop Bull and Pop Plus Bull and Pop Bear and Pop Plus Bear trades that showed up during the day, and I pick 5 or 6 that I really like that I maybe didn't get into that day, but I think they've got a lot of potential, and I put them on a watch list. So that starts my watch list for the next morning. And then I also go through some of the other scanners. I go through through a couple of the other scanners that he's got here. I use the movers and reversals, and I look at breakouts and green lines and trends, and I just scan real quickly. It doesn't take a lot of time. I just go through and I try to find some stocks that look like they have some good potential for the next day, so that I've got a decent list to work from in the morning. Some of them may work, some of them may not work, but at least I've got a starting point to get ready to go. So that once I've got those, I'm ready for the morning. And then in the morning, I usually start around 7:30 or 8 o'clock, and I just kind of look for any kind of movements on stocks that come having earnings, anything dramatic that perhaps that I see as far as big movements, and then I analyze those stocks, take a look at Pete's platform, find out if they're on a buy signal, find out if they're on a sell signal, just find out if they meet the criteria that I would be interested to trade. And when the market opens, of course, we all do the same thing. We look at the typically on an up day, we're looking at the Pop Plus Bull and the Pop Bull, and we're finding prospects, and we're tracking those to find out which ones we think would be good prospects. And you just have to kind of wait to see what the market's doing. Obviously, I use Pete's comments first thing in the morning to give me an indication of how I feel like I want to trade that day. Do I need to wait for a while? Is the market likely to go up? Is it likely to go down? Is it likely to go sideways? I depend a lot on his market analysis to make a determination of how I'm going to trade, at least initially. Maybe whether I should hold off or get into the trades right away. And that's obviously really important. Now I'm going to talk a little bit about some of the resistance lines and things here. Let me go over here. All right, this is a. Let's take a look at. I want to take a look at one of the ones that I traded today, which is Yelp, which I'm still in that particular trade. Now, this is TC2000, but it's the same for everybody else, and that's a 5-minute chart. But I'm going to look at the daily chart, because all of my trades basically initially start with a daily. The daily is what I'm looking for. I'm looking for breakouts or breakdowns on a daily chart initially. I don't go to the 5-minute chart till after I've looked at that. But I want you to look at this Yelp, and if you see 2771 right there, that's that little white line that I've got drawn across there. 2771 corresponds to the high of this candle right over here, which is the highest point that Yelp get into before after this big gap down here. So what I did was I set an alert for Yelp to enter that trade when the stock got through 27.71, which is what I did. And you notice today that it went through 27.71, shot up here, and then pulled back, and probably shook a lot of people out. Now, my line in the sand for that particular stock was 27.71. It had to close below 27.71, or I was going to stay in that trade because, as far as I was concerned, it was a swing trade. And the reason I liked it as a swing trade is because if you look up here and you see that's $32.36, that gap. So I've got a $5 potential profit on this particular stock as long as it stays in that gap. And my downside, let's say I get in at $28 or $28.25, my downside is maybe 75 cents or so. So basically I've got a 75 cent loss versus a $5 gain. So for risk reward, that is a big trade for me. So that would be one that I'm going to stay in. I'm in it overnight. In fact, I added to it when it pulled back to 27.71 today. But I had made a determination when I get into the trade that this was going to be a swing trade for me, not a day trade. If you get into it as a day trader, your whole strategy has to change because you're looking to maybe make 50 cents, 40 cents, 30 cents on the trade and then exit. And if that's your particular analysis on that stock and that's what you're trying to do, then that's when you would exit. Your methodology and your strategy for the trades that you make and the exits that you're going to do have to be based on whether you want to do it as a swing trade or a day trade. And that's really important. A lot of times people just jump into trades and you have to know where do I want to get in, where do I want to get out, am I going to do this a swing trade? And the reason I say that is a lot of times for example, on the platform, when you find a stock that's breaking out, and it breaks out first thing in the morning, the market opens at 9:30, the stock shoots up $1.50, $2, $3 in the first 20 minutes, and you're not in it, so you're not chasing it at that point. But let's say for example that you've got a breakout. Let me find one here. Find a good one. Right here. I know what I'll do Legend. All right, here's Legend, and this is one that took off pretty quickly this morning. Now, when I'm trading this, again, this is a swing trade for me. But when you get into a trade, if the stock runs up on you really quick in the morning and goes up and then it starts to compress again, if you decided to enter the trade, for example, right here on this compression, now, the breakout, the daily breakout, was way back down here. So when you enter the trade, you have to make a determination of, am I into this just for a day trade or am I into this for a swing trade? And why that's important is when you enter the trade, right here, and it starts to run up, and then it starts to pull back, you're going to take profits if you're just into that for an intraday trade. But if you're in it for a swing trade, your stop is not going to be here. Right here. It's going to be down here where it broke out on the daily. So there's a lot more downside. So your loss could be a lot larger, but you're in it for a longer period of time. You're looking to swing it in because you think it's got a lot of potential to the upside. So what I'm saying is obviously when you're in it for an intraday trade and you get in right after compression, you probably want to set your exit right there below that compression. Not way down here at the breakout for the daily, but of the breakout for the 5 minutes. And Pete's gone over this several times in the room. But for me, when I'm making trades, if I'm doing intraday trades, that's what I'm going to use. But if it's a stock I really like, and I think there's a huge amount of upside for it, then I'm going to set my stop down at the daily breakout, which could be obviously a lot further down. And obviously, I've got a lot more risk. But if you look at Legend on this chart right here. You see this nice breakout right here. Okay, if you look across, and I have a term for these things. I call these A-flush triggers. But when a stock goes up and breaks across a horizontal line like that, and then starts to go up, and it went way up here. You see where this is right now? It's right on the bottom of this red candle right here. That's an A-flush trigger. So where do I anticipate that this stock is going to go over the next couple of days? I anticipate that it could get up to the top of this particular candle right here, this top of this red candle. Hope you can see that. So what I'm looking at is the stock going from $106 to $110. That's another $4. That's another 4%, 3.5%, which I'd be willing to stay in as long as the stock didn't break down below this daily support. And I hope that makes sense. And that's important when I'm trading. I have to know whether I was going to be a swing trade or a day trade. Now, that doesn't mean sometimes I don't turn day trades into swing trades and change my mind. But when I initially get in, I try to have that idea in my head as to whether I'm going to plan on taking this for overnight and for a day or two. And because swing trading has been very difficult the last 6 or 7 months, so I have to have something that I feel like the potential to the upside is very high. So, you know, when that happens, you got to be prepared for more drawdowns and to hold for 1 or more days. Okay. Couple things on the day trades that I also take into consideration, and that is when the stock goes up, and Pete's talked about this a lot, when the stock goes up and starts to lose momentum, starts to compress again after you've got some profits, you know, there's 2 things you can do there. You can, and generally what I do is I take profits at that point if it's an intraday trade. And then when it pulls back, that's fine. But if it compresses again and starts to come back up again, then I may re-enter the trade. Some traders actually, when it goes up and compresses like that, they'll actually add to the position at that point, anticipating that it's going to go up. That's really a personal preference as far as how you trade. I'm relatively conservative, and I'd rather take the profits when I've got them. And then if it breaks back up again, that can always re-enter the trade later on. And that's even true for swing trades. If you have a trade that you really like and it breaks down below your support level on the daily, and then reverses immediately the next day, and you took a little bit of a loss on it, don't be hesitant to get back in again. If technically it's still set up and looks like a good trade, just jump in. I mean, and take the position again because you liked it before. It just happened to fail, but it may not fail this time. Now, as far as determining how much profitability there is on a trade, one of the things that I showed you was the Yelp, the big gaps, and on Legend, that big red candles to the left. Those are profit targets that I use. That's how I determine what I think my maximum profit target could be on a stock. It's going to be a big red candle to the left or a gap fill, and those give you a good idea of what your risk reward is going to be. Now, on a stock, for example, like BCRX, I look over here on the daily on BCRX. You see this BCRX trade right here. Now, this is a pretty nice. It's a pretty nice pattern. I mean, there's a nice breakout. You've got a nice buy signal on it. If I look over here, I say, well, you know, I've got a really nice upside here. It's 10.25 up to 11.46. It's you know, $1.25 on a $10 stock. That's 10-12%. That's nice. But the thing for my trading methodology would not allow me to get into that trade unless this thing got through this 50-day moving average right here. See the little red day 50 moving average? So from my standpoint, when I look at a trade like that, I don't think I have more than from 10.34 to about 10.50. I only think I have about 16 or 18 cents profit potential on that trade. So it's not a trade that would be one of my favorites, and I probably wouldn't take it unless it got through there. Now, if it got through there, I would definitely take it because now I can go from 10.65 all the way up to the top of that candle, which happens to correspond to the 200-day moving average. Those are profit targets that I would have, but that would be a trade that, even though it looks really nice, when you put the 50 on there, to me it doesn't look nice. Now, I know a lot of people don't trade like that, and a lot of times it'll shoot right through the 50 and keep on going, and I look like an idiot. But that's the methodology I use, and where it helps me is it puts me into fewer trades, but more what I consider higher probability trades, higher probabilities of making profit on the trade, on something like that. So I think you've seen me post these things out there. You know, the 50 is 10, 20 cents above this, and I'm not going to get into it when it gets to that point. I think, like, if you look at Walmart right now, Yeah, if you see Walmart, right now Walmart had a nice breakout right here. It's on a sell signal, went on a buy signal today, but you see the 50 right there. Now, if it gets through the 50, look at how nice how much profit potential there is on this big red bar, because there's nothing over here on a daily except this red bar at this point. So that's a big, what I would consider a big trigger. But if I was interested in it, I wouldn't get into it until it gets through that 50. Now, if you were into the trade and let's say you were long Walmart today, when it gets up near this 50-day moving average and it starts to compress, probably a good time to take some profits right there, because you're running into a definite resistance. And believe me, these moving averages, the 50 and the 200 especially, and even the 100, offer some pretty strong support and strong resistance on stocks, which is why we try to use those when we're doing spreads and things like that to come up with where our short strike is going to be, so that we've got some basically some support well above where we put the short strike on. I'm just going to bring up a few of the. I want to bring up a few particular stocks, and if you have any questions, I'm certainly, hopefully, I can answer them for you. Don't want to take up too much time, but I'm just kind of going through my thought process of when I do try to trade. One of the ones we had today was AKRX, and if you look at this AKRX trade, now I took this trade, I think several other people took this trade, and on the platform, here it is here. Here it is on the platform. Nice buy signal here. Nice breakout right here. You can see that beautiful breakout. Notice where it closed yesterday. Right smack on the 50 moving average with what's called the doji candle. And then look at this nice run up today. And I exited the trade and took money, but if it opens green tomorrow, I'm going to get back in again, because you see you've got this potential for it to at least run up to this top of this candle, and once it gets through there, it could run all the way up to 100-day moving average. So this is still a really nice trade, and it could work tomorrow as well. I think Pam was in JDST today, and I want you to notice something on JDST. You noticed the buy signal yesterday, okay, and you noticed that it went up today and it screamed right through the 200-day moving average and crashed right into the 100-day moving average, and then dramatically pulled back from there. Now, yeah, the market conditions had something to do with that, but what you're going to find is how often these particular stocks will move up and run into a moving average like that, and then just reverse. And that's why you got to be aware of those particular levels, because that would have been the perfect place to take profits in this. In fact, I think PM traded that, and I think he actually went short when it did that. Which actually, even though it's counter to the buy signal, it's still not a terrible trade because of the fact that it hit the 100 and failed. So that's those moving averages are really, really important. LLL is another one that I entered today, and I took this overnight. And let's go back to the platform. Look at that. Look at triple L. The lines come up here. All right, hold on just one second. Move the template back. All right. Okay, here's triple L, and this is the triple L on the daily. And you see how far this stock had run up and then ran way down. Now, the breakout on this is basically right about here, which is really kind of where it broke out yesterday. But again, it has some tremendous upside to this thing still. And, in other words, it could run up to the top of this particular candle here. And that's $5-6 on that particular run after it ran well today. But notice how this stock fell, red candles all the way down, and notice where it stopped. stopped dead, gapped up, and then took off like a shot. So it can move a lot, which can give you some pretty nice profitability on a trade like that. Let's see. I think I already talked about Legend. Yeah, Legend is another what I consider a really high probability trade because it's got so much upside potential. So this is the process that I go through when I look at a trade. When they come up on the scanner, I bring them up on the chart, and I make some determinations as to how much upside potential is there for this particular stock. Give it a little bit of consideration of maybe what it's done in the past, how choppy is the chart pattern. But those are things that I look at. So that, to me, this Legend, even though it didn't do an awful lot today, it was up some, but it's still got plenty of room to run. And one of the ones that Pete pointed out today is Dow, which, that's a beautiful pattern. Look at that candlestick today on that pattern. And if I bring it up on the TC2000, if you look at that trade, you draw a line across there, that's a major breakout across the top of everything. So basically, you're up in the air here, which means you've got some pretty big upside potential on a stock like that. And that's a beautiful breakout. Look at that breakout right there. And you look at something like that and say, this thing could run, it could run $5, $6. It may not do it tomorrow, but it could run a long way up on stocks like that. So those are some of the ones that I was looking at, and I made a list of a few to take a look at for tomorrow morning. These I put on my watch list. And first one is NBIX. And again, you got NBIX right here. It's coming over the very top of this particular signal on this one. Yeah, there's a buy signal today on it, right there. And if I go to NBIX over here, there's your pattern. There's your breakout. And where's your resistance? There isn't any. So you've got a lot of room to the upside on a stock like that. Netflix is another one that we talked about today. If you notice the breakout on it, again, it went right to the top of this red candle over here, and it's got more upside, another $5, $6, $7 to the upside on that. That's a pretty strong breakout on Netflix. Baidu is another one. Baidu is, I do something a little bit different, I think, than some people do. This little white line you see here is what's called, I consider that what's called a descending resistance line. Basically, I take the top of this particular candle, connect to the top of that candle, near the top of that candle, and we're right through. And today, Baidu broke through that. And that's just like going through a horizontal resistance line. To me, it acts as a fairly significant breakout and turns it into a buy for tomorrow. And we'll go in here, GWR. Take a look at GWR. And again, we look at it on the platform. GWR. There it is, a buy signal breaking out. If you look to the left, you see this red candle. Here's your first target right there, and the next target after that is going to be way up here. So that's a fairly significant risk reward to get into a trade like that. And you basically have your horizontal line right there. So if it gets below 70.36, it would be you could exit something like that. So that's also a good one. The things I just did real quick tonight, just kind of ran through, just trying to find some prospects. AOS is another nice looking one. Buy signal's way back here. It had quite a bit of volume back here. It's breaking out. And if I switch it over to here, there's AOS. Again, air above. So when that happens, you can get quite a good size run to the upside. And what I would recommend on something like this, when you get into a stock that's basically breaking to all-time highs, when the stock goes up and it starts to compress again, that's probably a good time to take some profits, because I mean, you think about the people that have bought that stock, and it's run up, and now they're getting antsy, and they're thinking, okay, this thing's run up a lot. I'm gonna start taking some profits, and you don't want to be caught in it if it reverses quickly, because they'll do that. But as the way Pete teaches it, you just look at your 5-minute chart, look for compression, look for it to basically lose momentum and start going sideways. Get out, take your money, and go. There'll be plenty of others. And one of the other ones was Now. This is another good one for Service Now. Nice breakout right here. Look back on. So I mean, there's so many opportunities that you can find using Pete's scanner to find opportunities to trade in the morning, and basically just put them in a watch list. And when the market opens, they're going to sort. The ones that are green are going to sort to the top, and you're going to be able to know which ones are ones that you would consider entering. And if they don't perform, you don't take them. I mean, you just skip it and move on. And also this Sprout Farmers Market, which somebody had that's in the room today. It was really nice pick. And that was I didn't get it, but that was a beautiful trade. It broke through this horizontal line. You got plenty of room to the upside here, another $3 to the upside. That's another good one, and I have that down to trade tomorrow morning. So that kind of covers pretty quickly the methodology that I use. Hopefully it's kind of clear. Like I said, the important thing, I think the key things to understand is that if you're going to be a trader to make money, you've got to depend on your technicals. You have to have convictions in the trade that you get into. When you get into a trade, you have to believe that you get into the trade for a good reason, and it's going to perform the way you expect it to, so that you don't get shaken out of it too soon. Really important, because you've got to make the good ones work. And I'm as guilty as anybody of getting out of trades sooner than I should. But it's really important. I don't look at my PnL. I just look at the technicals. I look at my 5-minute chart and my daily chart, and that's where I make a determination whether to get in or get out. And that's really important when you're trading options, because options prices, as everybody knows, can fluctuate a lot, and a lot of times they'll fluctuate not necessarily based on the stock price. You get volatility, you get time decay, you get a lot of things that affect the price of the option. So if you're going to exit a trade for a loss, don't do it based on the price of the option. Do it on the price of the stock. Make sure the stock has fallen below your support level before you consider getting out, not just because the options have dropped. Because the option could drop, prices could have dropped, and the stock could still be strong and well above your support lines. It's just the options aren't performing the way they should, and they'll tend to do that sometimes. So make sure that you're exiting based on your technicals. Again, if you're looking at the stock, you're whether you're in it with an option or you're in it with a stock purchase, you're just looking at your technicals on those particular levels. So those are, not trading your technicals, and knowing why you're getting into a trade, and knowing ahead of time where your exits and where your entries are going to be is really important. My profit exits, my loss exits, am I swinging it, or am I taking it just as an intraday? And you have to, I have to know when I get into a trade why I'm getting into the trade, and how much upside potential do I got. I mean, obviously you want your risk reward to be as much as possible. And if you get into a stock and you get a 10-cent upside to it, there really isn't any point in taking any risk. But that kind of covers pretty much what I wanted to cover. Like I said, I've been talking about.
Dave, it's been awesome. Thank you so much. For any of you that are online, if you want to type your questions in, I'm going to continue to have Dave control his screen. So if you've got some questions, type them in now. I'll read them to Dave, and then he can impart his information to you. I know that Lou had asked, as far as your criteria, what do you use for your list that you're putting together? because Pop Bull and Pop Bear can have 20 plus stocks in them. How do you
Right.
sift through that and narrow that list?
Well, the first thing I do is when I pop up a stock from the list, I obviously look to see if you get to all the Pop Bulls and the Pop Plus Bulls, a lot of times some of them aren't necessarily breaking through. They're near breaking through, but they haven't broken through. But the key thing that I look for in something like that is what kind of upside potential do I see with the stock? I mean, to me, that's one of the most important things. When I enter a trade or I put money into a trade, I want to feel like I have the maximum potential profit to make it worth my while. So that's why I look at the moving averages. I look to the left, to the what I call the triggers, to the candlesticks to the left-hand side to see where they've gone, and I also take a look at how this stock performed when it broke through a resistance level prior, maybe 2 months ago. What did it do? Did it go up and fail right away? Because I mean, a lot of these stocks will not trade well. I mean, you know, Pete, you have the certain stocks you just don't like to trade because they look beautiful. They just don't perform.
Exactly. If you see something that's got nice tight patterns and you can look at the chart and say, I think I can predict where this stock is going to go, well, those are the ones you want to trade. You've got other stocks that you're going to bring up in the Pop Bull list. They're choppy. They're all over the place. It's just random price movement. Well, those you can quickly just toss off to the side. But as long as you've got that really tight compression, you've got the breakout, you got the buy signal, and you've got some volume in there, you know you've got the criteria. So, and if it's the tighter, the better as far as I'm concerned. We looked at Yelp earlier tonight. Boy, that's the stuff that makes me salivate. I see a chart like that and I go, yeah, I like the compression. And we're just starting to poke through right now. We're not 10 or 15% above that breakout. We're in this trade perfectly. I mean, it's early. This thing, you get in at the early stages, you've got lots of staying power. You know there's a huge support level below it. So those are all things
Right.
that I like.
And if you look at when you look at the stuff, like one of the things I always look at is, you know, what's my upside potential, and I use my resistance levels above to make a determination whether it's a good trade or not, and that way I can cull it down pretty quickly to you know, the 5 or 6 or 7 best trades that I would consider. You know, I may miss some like that, but I have to have. You have to have conviction when you shouldn't be getting into a trade if you're wishy-washy about what you think it's going to do. You've got to have a belief and a conviction in your technical analysis of the trade that you're getting into, so that you will have staying power for that particular position. And then you also have to be able to recognize when you were wrong and it's not working the way it should, that it's time to get out. And it's got to be completely unemotional. You can't have your ego involved. You can't have your PnL involved. It's got to be just, to me, it just has to be strictly technical. That's the only thing I use, and it keeps it easy for me because I can get in and get out of a trade based on the technicals, and I'm not, you know, make money or lose money, but that's just trading. That's just the way it is. And you know, there is an art to this stuff. I mean, I know everybody's seen Pete pick some of these stocks. And you look at this, it looks pretty good, and the thing will take off like just take off like a shot. And you say, you know, how did he identify that? Well, you know, to what I believe is, I think the more you do this, the better you get at it, and the more instinctive picking some of these trades become. You have there's an art to it as opposed to just a science, and that just comes with experience, I think. Pete, what do you think?
That's very true. And during a flat day when nothing's going on and you get bored and, you know, you've got the TV on and you're playing solitaire, there are other people who are in there digging, and bam, hey, look what I found. This thing is fantastic, and they're all over the trade. So if you're not digging and searching, you're not doing what you need to during market hours. I missed trade yesterday that Richard got in, the UVE. I got lazy. I'm like, you know what? There's nothing going on today. I really don't want to stick my neck out. Then I looked at the trade and went, oh my God.
Don't be confused by the fact that this is hard work. It takes a lot of work. It takes a lot of preparation. It's not easy. You know, I've been through a lot of different programs, a lot of different chat rooms, a lot of different. I've seen just about every guru out there who tells you about how to make money in stocks. And if they make it sound like it's easy and anybody can do it, just take off and run the other way, because it's not like that. I mean, it just is not like that. But if you stick to it and you can make it work for yourself by getting your emotions out of it, get your technical analysis down, follow the information that comes through Pete's platform. The scanner, and I tell everybody this, the scanner that Pete has, which basically finds your prospects, that scanner itself is worth 3 times the annual subscription rate, because if you don't have good prospects, you can't make any money. You're just in there guessing. And that particular scanner is worth its weight in gold as far as I'm concerned.
Yeah, me too. When it's down, or when I haven't had it, I'm lost. I am really lost. So let me get to a couple of other questions. Ash is asking, do you use any particular tools to keep track of your positions?
Well, I have all of my positions. I trade through Interactive Brokers for the most part, and I keep my portfolio up all the time, so I know what my positions are. And then I do a spreadsheet every night on my trades for that particular day, my closed trades, and entered the stocks that I entered and the ones that I closed. I do a spreadsheet, and I keep a spreadsheet that has a particular methodology or strategy that I use to enter that trade. What was my reasoning behind that? Whether it was a gap fill trade, it was some sort of a technical breakout, whatever it was, I keep my results based on that, so that at the end of every month and every 2 months, every 3 months, I can see if I'm into some trades that maybe aren't working. And I can also go back and I can look at my losing trades, and I can go back and analyze those, and again make a determination of did I make a mistake by doing this? Because everybody makes mistakes. We all make bad trades, and the most important thing you can do is to learn from those bad trades so that you don't make them again, because there's plenty of other mistakes you're going to make. But yeah, I know I don't have more than, for day trades, I don't have more than about 5 or 6 maximum on at any one time. Mm-hmm. That's about all. That's about all I can manage, because I've got to be tracking them, and I don't want one to get away from me, either going down or going up. So yeah, that's how I don't write them down. I just have them on my screen.
Likewise for me too. I'd say 5 or 6 is a good number for me. Anything more than that, and I start losing track of it. Plus, I'm watching the market constantly, which I urge you all to watch the market very, very closely. Next year, as I start to contemplate things that I can add to the platform, I am going to unpin the charts so that you can have a couple of other charts up. I highly recommend having a 5-minute chart of the S&P up so that you can watch what it's doing. Everything follows the market. And I know, Pam, you're asking what market conditions are best for spreads. The best time to do spreads is when you know you're going to be trapped in a trading range. And if you're going to be moving sideways, and I think that's what's going to happen the next 2-3 weeks here, I think that there are going to be some great spreading opportunities. You've got seasonal strength working in your favor, so I would tend to be focusing on bullish put spreads. And the other time that spreads are very effective is when you get a deep market sell-off and the option implied volatilities spike. And that's another good time to start selling out of the money put spreads, especially when support starts to be established like it was in September. So I'll have Dave eventually pass the controls over to me, and we'll take a little closer look at that. Jeff is asking, how do you determine what size you want to trade, whether it's for shares or for option contracts?
Yeah, well, that's a little hard to define sometimes. Basically, when I have a base position that I take, whether it's an option or a stock, what I would consider my level position. In other words, I take, let's say I take 1,000 shares of a stock. That's my base position. If the stock is $20, I try to start with the same investment amount in any particular trade. So, if it's $20 stock and I buy about 1,000 shares, I've got $20,000 invested in that particular stock. If I buy a $40 stock, I might do 500 shares. So I basically have the same amount of money in any particular trade. Now, if my conviction level and perhaps the risk reward is much better, or the stock starts performing the way that I feel it's going to, then I'm going to, and I do similar to what Pete does. I'll go to a 2 times a position and a 3 times a position, depending upon my conviction level. But I start, all things being equal, when I take a trade, I try to keep the initial base amount of money that I put into that particular trade the same. And the reason I do this, for me anyway, is I find that if I've got $10,000 in stock in one trade and I've got $40,000 in stock in another trade, I'm going to be watching that $40,000 trade more closely than I'm watching the $10,000 trade, and that's not the way to trade. You want to be equally interested in each one of your positions and treat them all the same. You don't want to take the 10,000 and forget about it because I've got 40,000. So that the only time I scale up like that is if my conviction level is high and I feel like that this thing is just going to keep on going.
And likewise here, and in fact, given market conditions, I may scale everything back that I do. When I was trading in August and I saw the sell-off coming, I scaled up. But again, I'm a little bit more cautious then because we've been in a 5-year, 6-year bull market. Well, I don't want to get overly aggressive getting short because I know that there's a chance that the Fed or central bank, anyone could come out with a statement and run the market the other way. So I'm not going to be overly aggressive on the short side. And maybe I'm half as committed to the short side as I would be to the long side. But when we got that sell-off in September and we retested that low, pardon my French, I was balls to the wall. I had it all out there, and I was long options, very intense trading for me, but I know that there are a few times a year when I can do that, and those time periods, they make my year. And the rest of the time, I'm biding my time, I'm trying to find my spots, I'm engaged, I'm looking for that setup and waiting and making money, but I'm not nearly as aggressive. Right now, I'm about as flat as I've been all year because I see the market.
I will say one thing. Pete's a real seasoned trader. And, I'm sure there's some folks that are relatively new, haven't been trading a lot. One caveat that I would say is if you take a position on and you're nervous about that position, in other words, you're really scared. I mean, it's basically you've got too much money in that trade, then you should back off and cut it back. You should never have more money in a particular trade than you're comfortable with. Pete's been doing this a long time, and I've been doing this a long time. But some people, if they put $1,000 in a trade, they were wrecked if it goes down a couple $100. And some people, they put 10,000, and it doesn't even faze them. You've got to trade size based on what's comfortable for you. And if you're starting out, it's very important to scale up. As I said when I first started talking this evening, when I first started doing options, I took one option. That's it. I didn't take any more. I just took one option trade. That was it. One contract. And that seems like nothing. But that's how I learned, and I was comfortable. When if I jumped up from 1 to 5 and I felt like that was too much, then I'd back off a little bit. So I think you have to kind of get emotionally adjusted to your level of how much money you've got at risk.
Yes, and trading rule number 1, scared money never wins. That is my number 1 trading rule. And so when I do size up, you heard me say the second mouse gets the cheese and, all sorts of other tidbits of information. I need to make sure that when I'm sizing up, I've got everything working in my favor, and I'm looking for for the position to move instantly in my favor so that I've got some breathing room. But you don't want to be scaling up unless you've been doing this for a while. I mean, really using all of your capital in your account. You always want to have cushion, and you want to scale into positions. Scale out, scale in. Pam, you're asking what market conditions best for spreads. I'll go over that a little bit. And Dave, do you use any particular long-term indicator for a market breakdown?
Well, what I do is I look at for my market. I go by you, of course, but the things that I look at is I just look at the SPYs, the Qs, the IWM, the Russell 2000, and the Dow Jones Transports, and I look at those four indexes, and I look at what the candlestick pattern looks like and where they are as far as the moving averages are concerned. We talked today about the SPY, and you mentioned, Pete, that the SPY got through the 200-day moving average. That's a big deal. And if you look over at the triple Qs, look at that candle, and you look at the IWM, and you look at that candle. That's got the 100 above. And you look at the Dow Jones Transports, you look at that candle. Those are all bullish candles. You've got four indexes here that, to me, broke out today. So there's as we talked about convergence. It has been before, like the transports were down, the Qs are up. Today we had everything going the same way. So the market had been pretty much going sideways for a good long time. And if you look at the SPY, I mean, look at the way this thing came down, touched this, moved back up again, came back down. It was basically just trading in this range, and it looked like it was going to fail. And it went right down here to the 50, bounced off of there. But to me, this is a pretty important candle right here today. I don't know how you feel about it, Pete, but that looks pretty bullish to me.
Oh yeah, I agree. We should see some follow through buying tomorrow. We've got option expiration coming up, so that's also going to fuel some short covering, and the condor traders are going to be scrambling tomorrow.
Yeah, that's you've talked about that before. To answer Pam's question, since most of my trades are just relatively short-term swing and intradays, except for my investment account, I don't really worry too much about like weekly charts and monthly charts. A lot of people use those for looking what the market's going to do. I don't really care. I mean, I want to know what the market's going to do today and maybe for the next few days, because I'm going to trade in that direction if I can. But if the market's goes into a bearish market, I don't care. I'll trade to the short side.
Completely agree. So great. Well, Dave, I'm going to have you pass the controls over to me. I'm going to field a couple of questions here, and just fantastic job. Really great stuff.
Bring this out here. Change presenter. Okay, I'm going to change presenter. And thanks very much for giving me the opportunity to speak with everybody. I hope some of the things that I talked about were helpful.
Oh, they were fantastic. Especially, I don't spend enough time on how to evaluate target profits and such, and so that was very, very helpful. And how to look for the prospects. So let me see where trying to see if you're changing. Do you remember how to change it back, or?
There you go.
Okay, great.
You should be back.
I think my screen's probably showing up. And so, yes, we are back. So there are a couple of things that I wanted to answer. How do you get the 8-day exponential moving average? If you go into the studies here, all you do is select the exponential moving average, and then it's going to ask you what time period you want to put in. You put in 8, you select your color, click OK, apply, and then you've got your moving average. Now down here, this little triangle, you can't see it because of the screen resolution I'm having to use, but this is where you save your templates. And so if you want to have all three of the indicators, 50-day, 100-day, 200-day, 8 EMA, whatever you want, save that template as favorite or whatever you want to name it. And then when you want to look at that chart, all you got to do is click here, and then load that particular chart up, and you'll have the 8 EMA. Dave and I have talked about this. I prefer the 6 EMA. That's what I've used, and we both independently came up with that. We just started talking about it, and it was kind of funny that he uses a EMA as well. Let's see, trying to see if there was, I know there was another question in here. Yeah, in terms of longer term market movements, read my market comments. I put so much time and effort into the analysis. My forecasts are usually pretty spot on, and especially inside of a 2-week window, they're quite good. I do want to go over a few different notes from Dave's presentation tonight. He had mentioned using time stops. I use time stops a lot. I get into the trade, I'm looking for movement right away. If I don't get it, if I'm in a day trade and I don't get it, literally every minute that goes by, I'm starting to watch the clock, and if I'm expecting the stock to take off and it doesn't, especially when I've got the market moving in my favor, I start considering stopping out. Same thing with swing trades. If I'm in for a day or two and I'm just not getting the price action and everything else is in place, I'm just going to get out and I'm going to continue to evaluate. I can always re-enter. Dave had also stressed the importance of entry. Why am I getting into this trade? From my perspective, I'm super selective on my entry, and I get really upset with myself if I have a bad entry. I'm only in control one time during the life of the trade, and I mean truly in control, and that's when I enter the trade. So that's how I view it, and I want to make sure that I have everything working in my favor, and that includes the market. And so we talked a little bit about sizing, and the market, everything starts with the market. It all starts with the market. You can see individual stocks that look fantastic and you get all excited about how they're just flying. You have to keep it in the context of what the overall market is doing. If the market's not moving against me, okay, I can get excited about the trade. But if I have the market moving against me and the stock is flying, I'll get out of the trade. I know I can always get back in the trade, and I miss some movers, but usually it ends up being a good thing that I was paying attention to the market. Let me give you an example. This is a classic example. And this was when you could see how it's been falling. Well, earlier today it had this big decline right here, and then right in here was 1 o'clock. It was the FOMC statement, and I was in this short and was working out really well. Then I watched it continue to drift lower as the market rallied, and here's how you get. I'm going to put WYNN in. I'm going to just hover over the chart. Then I'm going to type in SPY. As soon as I do that, you're going to see an overlay of the SPY. So here we get the FOMC minutes, and you can see the market rally like mad. Well, what does the stock do? It starts to sell off. So I've got relative weakness here. I'm getting pretty excited about it, so I'm not really worried about it. And I thought I'll just let it drip lower, moving against the market. This is great. I was smart enough to put a stop in near my entry point. And so I started to focus on some bullish trades, and I looked up and I'm like, oh, wow, I got filled. Well, what the heck's going on with Win? Well, it started to rally. So even though it appears that you're in a good short position, you have to be aware of what the market's doing. And what I should have done was I should have counted my blessings and said, hey, I got a 40-cent profit in this thing. I was on the wrong side. I should take the money and run. I didn't. I at least put the stop in. But it would have been smart to just take profits and focus on bullish trades because that's what the market was doing. So very important to know why you're getting in the trade and to keep it in the context of the overall market. FedEx was another one that I wanted to highlight. And in this particular case, if I go to a 15-minute chart, you can see it has some nice runs, but then it starts getting really choppy. So from a day trading perspective, this is a really tough one to day trade. I mean, you got a really nice run in here, but even on the way down here, look at all the fits and stops and starts that you had all the way down. You know, you get a nice sell-off and whoosh, it comes right back on you. So I do like this stock longer term. And so this is not a great stock for day trading, but it does set up well for longer term trades. Now here you can see that I had a sell signal today. I'm not real happy about being in a position. I'm going to take that off for a second, clear the chart. I never like trading against a buy or a sell signal, but we do have a big breakout here through this horizontal resistance line right there. And we closed above. That was an open right there. So this is a new closing high. I think the stock has got a chance to run, and it will at least get to this level, but it has such strong seasonal strength that once it gets through this level right here, this 163 level right there, I mean, this has easily a chance to go up here into the 170 range, especially into year end. And if you want to see that, you just go into a weekly chart. You can go back and take a look. Now that's why we're in the trade right there. That is a seasonal trend. I can go back 4 years and show you that as well. That's why we got into this trade. And I encouraged everyone to just close their eyes about a month and a half ago. And I just said, just get in this trade and don't look at it for a couple of months, and if you look in December, you're going to be happy you got in the trade. Well, we've gone through quite a few starts and stops on it, but that's how the stock trades. It's 2 steps forward, 1 step backward, 2 forward, 1 backward. That's the pattern. That's how it trades. Don't let your PnL drive you. Use technicals, absolutely. And in fact, I hear a lot of people say, do you use a 5% stop? Do you use a 10% stop? I don't use any of that. If the stock is performing and the market's moving in your favor, let it run. Use the technicals. Use the moving averages. Use your horizontal breakout points in here. There is no set 5% or 10% stop or anything like that. I know people teach that. I think it's just craziness. So it's written in a lot of books, but I have not found that to be effective at all. I look at the chart, I look at what the market's doing, and I look at the momentum that it has, and I use the compressions a lot. If you get a nice breakout here and the stock runs up and it starts to compress and you're hitting other horizontal resistance levels, start taking some off. Get out. Swing versus day trading. A little bit talk about the market. It's very important to know when you need to be day trading and swing trading. And back in here, we literally had, look at these moves. I mean, these gaps down, you've got a gap up, then you've got a gap down, gap up, gap down, gap up. Every day we were all over the board. How are you going to swing trade this? This is crazy. You cannot swing trade that. And you get into very, very tight compressions like this. Well, you can't really swing trade that either because you have no follow through. When you're trading options and you're swing trading them, you know, I get a lot of people that want to trade with one option and they come into me, I love to swing trade options. You know what? So do I. I wish that's all I could do. But there are times when the market just doesn't set up for it. And so if you try and swing trade in here, you're going to get your head handed to you because you're going to be exposed to time decay and volatility compression. You're going to lose money. When you buy options, you have got to be absolutely perfect. And then you get the breakdown like this with the sell signal. Now we're talking. That's significant, and I'm probably going to get follow through, and I'm probably going to get follow through. If I can string 3 days together in an option trade, hallelujah. I'm all for it. You get a double bottom in here, okay? Right in here, I could tell that the way we were testing this and there was bad news out that we were going to release and we were going to run higher. Well, we were long this whole way, and we were able to swing trade in here, okay? So we're going to get a nice little opportunity in here for 2 or 3 days and we'll be swing trading again. But we're out of the 6-year bull market right now, and we're starting to slow down. There are a lot of swing trading opportunities in here, but this is the environment that we're currently in. And I think that for this year and next year, we're not going to be doing a lot of swing trading. We'll be doing more spreading and more day trading. And when we get a swing trading opportunity, I'll let you know. We got one right now for probably a couple of days in here. Ash, you asked me, how do I know what influence option expiration might have? Well, the more you click around this platform, the more stuff you find. I'm just going to go into market rating, and I'm thinking there's a lot of this stuff that I don't update anymore, but I used to. And I'm going to go through and I'm going to show you. There's a little expiration table in here, and you can actually see what happened the week of option expiration 4 months ago, 3 months ago, 2 months ago, and last month. And sometimes you'll see some really strong numbers in here that there's a trend. Market does tend to rally into expiration week, but not always. You know, this is August, this is September. So now we're back on track on the positive side. So you should see a bit of a bullish influence. And if the market's breaking through any kind of major technical level like it did right now, well, then you can be assured that you're going to get some more follow through probably tomorrow and Friday. And I think Dave talked about exiting a trade when the technicals are broken, but not giving up on the trade. Very important. Some of my biggest winners have come after my biggest losers. So VXX was a classic example back here in September. I got short VXX somewhere in this area right here, and then it started to come back up through the 200-day moving average, and I went, we got to get out of this trade. This is not good. And then it came up here, and it started to falter, and as soon as it started to drop, I went, okay, it's time to get back in. Well, I got back in at a better level for one, and for two, now I really had some conviction because I knew that there was a resistance line that I could lean on as well. And then when it dropped through that 200-day moving average, hello. So just because you get shaken out of a trade once, as long as you had the right idea and everything was setting up for a good trade, don't give up on it. Keep an eye on it. The next time that it falters, you'll be ready to take action, and you probably are going to be able to do it in a way where you can step up and have even more conviction to the trade. So I'm going to quickly scan through, and then we're going to call it a night. I know it's been a great night with lots of information. Dave's also given us some stocks to take a look at tomorrow, so I hope you put those on your list. Pam, fib ratios customizable. Well, I've got the fib ratios here, so I'm not sure what you need to customize in it. It's all the normal ratios that are used. So hopefully that'll suffice. As far as stuff that I'm going to be doing next year, I'm interested in trying to integrate some order entry on the charts. And I also want to be able to put up bid asks on the charts. I want to add earnings release dates, future earnings release dates on the charts. So there are some things I'm looking to do with the charts, but quite honestly, I don't have a lot of people using fib. If I get a lot of requests for something unusual, I might consider it. Every time I have my programmers work on things, though, the expenses are astronomical. And this is not going to be a thinkorswim platform, I assure you. It's going to have what we need, but probably not too much more on it. And I think that is, well, let's see, some stocks are too expensive to buy for day trading. Can you use options as an alternative? And how do you select options where applicable? As long as the option liquidity gauge is around, say, 5 or so, you can consider day trading options. on that underlying stock. But the main thing is the bid-ask spread. And if you've got option liquidity above 0, like 0 to 4, 0 or above, you can definitely consider it for swing trading. But anything below that, you've got to be fairly careful. And there, even a 0 to a -4, if I really, really like the candidate, I might do a credit spread on it where I can put it on once and not have to take the spread off. But yeah, use that option liquidity gauge to evaluate it. And the other thing is that if you are selling options, you got to make sure you've got a relatively high option implied volatility. If you're an option buyer, you have to make sure that you've got fairly low option implied volatilities, like a 35 or so. So today I did the Dow trade. There were a lot of trades I looked at today. I looked at Baidu, couldn't do it. Options were too expensive from an implied volatility standpoint. I looked at Netflix, couldn't do it. Looked at Dow and loved the pattern first and foremost, loved the breakout. I was able to buy those calls for, I think, about 10 cents over parity. If you don't know what parity is, it's another word for intrinsic value. And with 2 days left until expiration on a $53 stock that was breaking out, I thought that was a good play, and it turned out very well. So yes, you can, but I would caution you, do not day trade options. I've done it professionally. I've traded thousands of option contracts with the most unbelievable software, and it is very, 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 very difficult to do. You're constantly fighting bid-ask spreads, and you're trading against market makers. So, you know, if you see something that looks super good, but it's super wide and the options just aren't there, I would suggest take a pass on the trade and keep looking. Keep looking, and you're going to find something better. And percent change instead of dollar change in the scanner, that should be pretty easy fix. Percent change on the chart. Not sure how I would do that. So why don't you reach me offline on that? But just send me things that you'd like to have in there. I have had people ask for percent change here, and that'd be pretty easy to add. I don't want to make these columns too big though, because then it starts eating away at the chart real estate, and I'm very protective of that because this is the focal point for me. This is what I really want to look at. So, but yes, I can do that, and then you can sort according to percent change if that's what you like. Thank you so much for attending tonight's presentation. I look forward to having all of you in the chat room tomorrow. We got some nice trades to start us off with, and we should have some bullish follow through. So hopefully all of you have a few long positions on, and we'll look forward to doing a few more of these in the future. Thanks so much.